In terms of raw return potential, I'm more bullish on Bitcoin, and that's worked out well for the past 5 years. Just because gold's a 20 trillion plus asset, Bitcoin's a 2 trillion plus asset, and I think that Bitcoin being a 16-year-old asset, it's basically gold combined with a tech stock. It's growing into whatever total addressable market it's going to reach, whereas gold's already closer to its total addressable market. So in exchange for basically more tail risk, more volatility, Bitcoin comes with higher returns. And so on an absolute basis, I expect better Bitcoin returns than gold returns. But the way that I generally characterize it is because I've been a bond bear, I basically said, if you take a 60-40 portfolio and think, how can I improve it for a period of fiscal dominance? Well, one, you can take out some of the bonds and replace that with some gold, for starters. And then you can take out some of the equities and replace it with Bitcoin. So I generally don't really view them in competition. I just generally view them as different, replacing different parts of the portfolio. I think gold is more of a, it's more of a competition for bonds. And Bitcoin's more of a competition for some of the higher volatility parts of a portfolio, such as equities.
In today's analysis, we're dissecting the powerful macro framework of Lyn Alden, who argues that a fundamental structural shift has occurred in the global economy. The old playbook, where high interest rates would crush assets like gold and Bitcoin, is officially broken. We have entered a persistent new regime of fiscal dominance. In this environment, high public debt levels mean that when the central bank raises rates, it no longer effectively tames inflation by slowing bank lending. Instead, it blows out the fiscal deficit by increasing the government's interest expense, paradoxically adding more fuel to the fire. This isn't a temporary cycle, it is the new structural reality, and it fundamentally changes the investment case for scarce, non-sovereign assets.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
I do think there's a fundamental shift. And people said the same thing around Bitcoin. They were like, Bitcoin's a zero rate phenomenon. It won't do well when you have high rates. And here we are at high rates and Bitcoin six figures, and gold, comfortably well over 3,000. What changed was that we entered fiscal dominance. And so when you have pretty low public debt, and most of the money creation is coming from bank lending, when you raise rates, you generally slow down bank lending at a bigger degree than you blow out the deficit. On the other hand, when you have over 100% debt to GDP in the public sector, and most of the inflation is coming from monetized fiscal deficits, not from excessive bank lending, when the Fed does what they're doing now and they raise rates and try to keep them high, they actually blow out the fiscal deficit by a bigger number then they slow down bank lending. So they don't, for the most part, they don't greatly slow down total credit growth in the way that they're trying to. So basically, when they sharply raise interest rates in 2022, that temporarily brought everything down. But then as soon as we started to get some of your treasury offsets, we started draining the reverse repo facility. We were not really, even though the Fed was remaining hawkish around the margins, a lot of conditions were still improving at that point. And that's generally a sign of fiscal dominance, that even high rates don't really do what they used to do in terms of slowing things down. Sometimes they just add fuel to the fire. And so I think that's structurally what changed this cycle. And I think that's a more persistent regime that we're in now. That's not even a near-term thing. That's just kind of structurally the environment that we're in now. And so there's still be correlations where if the dollar goes through a strengthening period as it has, in recent weeks, that can put downward pressure on gold and certain other assets. But in the grand scheme of things, I think that correlation, that interest rate correlation, is severely reduced now. And it's more about what's happening fiscally, how independent is the central bank perceived to be, and factors like that, more so than just that interest rate correlation. So one, I think that cycles can change shape over time. So as we enter a more institutional phase, on average, I think we'll see a little bit less euphoria, but then potentially also a little bit less downward volatility because you're not coming off of that level high of euphoria. So when I look at metrics like market capitalization to on-chain cost basis, and so far we're nowhere near the peaks that we generally reached in, say, 2021, 2017, 2013, kind of those major multi-year tops. So this cycle has kind of been characterized by pretty strong upward moves, and then, maybe a 7-month consolidation, and then another significant upward move, and then another 7-month consolidation. I think that's a healthier market overall. Currently, we're in another consolidation. I wouldn't be surprised to see it continue for a couple more months. I don't really have any strong view on near-term trading. Probably my recent orange flag or yellow flag was the rise of these altcoin treasury companies. That's kind of a sign of froth in the market. Combined with, I previously mentioned maybe some of these economic deceleration risks over the next couple months. So I wouldn't expect to see a little bit more consolidation in the months ahead. But I do think we have probably at least another stair step up, like we've seen a couple of these this cycle, hopefully more than one. But I still think we're headed higher in terms of this kind of upward move and then consolidation and upward move consolidation. I still think we have more fuel this cycle. In terms of raw return potential, I'm more bullish on Bitcoin, and that's worked out well for the past 5 years. Just because gold's a 20 trillion plus asset, Bitcoin's a 2 trillion plus asset, and I think that Bitcoin being a 16-year-old asset, it's basically gold combined with a tech stock. It's growing into whatever total addressable market it's going to reach, whereas gold's already closer to its total addressable market. So in exchange for basically more tail risk, more volatility, Bitcoin comes with higher returns. And so on an absolute basis, I expect better Bitcoin returns than gold returns. But the way that I generally characterize it is because I've been a bond bear, I basically said, if you take a 60-40 portfolio and think, how can I improve it for a period of fiscal dominance? Well, one, you can take out some of the bonds and replace that with some gold, for starters. And then you can take out some of the equities and replace it with Bitcoin. So I generally don't really view them in competition. I just generally view them as different, replacing different parts of the portfolio. I think gold is more of a, it's more of a competition for bonds. And Bitcoin's more of a competition for some of the higher volatility parts of a portfolio, such as equities.
This new macro paradigm explains why Bitcoin has thrived despite high rates, and it reshapes how we should view its market cycles. Alden sees the current bull market as healthier and more institutional, characterized not by euphoric blow-off tops, but by strong upward moves followed by long consolidations, a stair-step pattern she believes has more room to run. Within this framework, she makes a crucial distinction between Bitcoin and gold. She is more bullish on Bitcoin for raw returns, viewing it as gold combined with a tech stock. However, she doesn't see them as competitors. In a portfolio designed for fiscal dominance, gold is the ideal replacement for bonds, while Bitcoin is the replacement for high volatility equities. They serve distinct complementary roles in a sound money portfolio.
So I don't think it's the only thing. I think it's one of the fastest horses available at scale with liquidity. So structural bull on Bitcoin. But also, I mean, gold over bonds is generally a beneficiary of fiscal dominance. Equities at reasonable prices is also generally a beneficiary of these situation. I talked about strategy, formerly MicroStrategy. A company that holds Bitcoin, which is scarce, and then they issue various credit instruments denominated in the currency that's we're running away in terms of fiscal dominance. So they put their liabilities and things that are debasing and their assets in terms of things that are scarce. And as long as they manage that conservatively through the various ups and downs and volatility cycles, they benefit. Even part of the reason why traditional equities can do well is because a lot of equities like locked in 5, 10, 20, 30-year bonds at super low rates, and bought back shares, and they still have a lot of those bonds outstanding. So their liability side is locked in and gradually getting inflated away. And the ones that have pricing power can keep ratcheting up their prices, and keep doing pretty well. So generally speaking, anything that has some degree of scarcity, whether it's an economic moat for a business or pricing power, or it's literal scarcity like gold or Bitcoin, is generally well positioned for fiscal dominance, outside of kind of localized overbought bubbles that show up from time to time. And then anything that can attach a short of fiat currency to those things generally adds fuel to the fire, as long as it doesn't get over its skis. The US is kind of locked into pretty high structural fiscal deficits going forward, especially on the spending side. And since that talk, the big beautiful bill has also kind of further locked in some of the things I've been talking about, which is, in any sort of investable time horizon, we're not meaningfully cutting Social Security, we're not meaningfully cutting Medicare or defense. Interest expense, even if we do get moderate short-end Fed cuts over the next year, on average, interest expense is now, I think, structurally higher than what we got used to over the 2010s. And so overall, we're doing pretty significant deficit spending. It's only partially offset by the increased tariff revenue, which is again mostly coming out from Americans, either the consumer side or the businesses, or a blend of both, depending on what products in question. And so overall, that tends to run things pretty hot, at least. And that's where the breakdown is really important, because if you're on the receiving side of the deficits, it's pretty big stimulus. On the other hand, if you're not on the receiving side of the deficits, you're more facing the tighter monetary policy. You're more facing the tariff revenues. You're kind of, out of luck, more or less. So it becomes very sector specific. And generally speaking, gold and Bitcoin, the benefit is they don't have margins to worry about. They're not subject to the tariffs. They're not buying things at higher prices and then trying to figure out what percentage they can pass on to consumers in the way that American businesses generally find themselves in right now. And so I think we're past the worst parts of this cycle's liquidity crunch, which was 2022. I don't really see that happening in the horizon. I mean, eventually we'll have something like that again, most likely, but nothing's really on the horizon for a major liquidity crunch. And so I generally think that market conditions globally are going to continue to be conducive for Bitcoin. To some extent, gold. We got a little bit overheated. It was one of the most overbought we've seen on the monthly RSI, which is why I got somewhat near-term concerned around gold. But structurally speaking, looking out 3 to 5 years, I continue to be quite bullish on Bitcoin and gold. And Bitcoin, I tend to follow a little bit more cyclically, and I still don't think that this particular bull market is finished yet.
The ultimate strategy for this era of fiscal dominance, Alden concludes, is to own scarcity and structure your balance sheet accordingly. Assets with literal scarcity, like Bitcoin and gold, are uniquely positioned because they have no margins to protect and are immune to things like tariffs. The winning formula, exemplified by companies like MicroStrategy, is to hold scarce assets while issuing liabilities denominated in a debasing fiat currency. Alden believes we are past the worst of the 2022 liquidity crunch, and that the global conditions remain highly conducive for hard assets. While near-term consolidation is possible, her structural outlook for the next 3 to 5 years remains unequivocally bullish for both Bitcoin and gold, as the fiscal realities that favor them are now deeply entrenched